Hi everyone, welcome to my channel. I'm Chrissy. I am a CPA-turned-product manager. I started out my career as a tax accountant, and during that time, I always wished we had better technology. So I became a product manager. Now I get to build accounting software for my fellow accountants. On my product team, I'm really passionate about teaching people the business context of why we're building what we're building. As I began to teach people more on these accounting topics, I figured there must be other people who are interested in learning these as well. So this video is the first of many videos that we'll be putting out to talk about accounting topics, specifically focusing on business valuations in private equity. In the following two videos, I'll be talking about a brief history of private equity, the difference between PE and VC, as well as the three high-level approaches to evaluate a business. And we'll be looking at some buying examples as well. Let's get started. I'm going to first talk about the brief history of private equity firms, and then the difference between private equity or PE versus venture capital, VC, which you'll commonly hear when people talk about private equity industry. Then I will dive a little bit deeper, but still on a very high level, to talk about the business principles and theory when we evaluate a private company. And then I will talk about the three main approaches to carry out the actual valuation. First, let's look at the history. The concept of private equity began taking shape before 1946. 1946 is a very important year for private equity industry, and I'll explain this in just a sec. The general idea is that the wealthy families and individuals invested directly in private companies or in partnership with other investors. Here on my screen, I'm showing you two pictures. One is for Queen Elizabeth I, and the second one is for Sir Francis Drake. In 1577, Queen Elizabeth I secretly founded the voyages that was led by Sir Francis Drake. When I say voyages, it's basically robbing the ships from Spain and capturing their gold and whatever treasures the Spanish people found. The cut from his voyages was so massive that Queen Elizabeth was able to pay off her entire foreign debt and had even left over to continue her exploration and founding for future voyages. And this laid foundation for the prosperity of England at that time. So she was doing private equity before it even became a buzzword nowadays in the business world. And now we're moving on to what happened in 1946. The first private equity firm is generally considered to be American Research and Development Corporation, what we call ARDC, which was established in 1946 by George Troyd. ARDC was a pioneer in venture capital, which is a subset of private equity. And this made a historical investment in Digital Equipment Corporation, DEC, that yields significant returns. And here I'm showing a picture of the founder of ARDC. Digital Equipment Corporation, DEC, went public in 1966, and ARDC's initial investment of $70,000 grew to a value of over $355 million. This is over 5,000% return on investment, or if you're familiar with ROI. So what are some characteristics of private equity? Well, first, you have to be investing in privately held companies. If you are just buying stocks on the stock exchange, you are not investing in private company, you're investing in public companies. Second, you have to have equity ownership. When we say equity, we are talking about stocks. Buying the shares, buying the stock, shares and stock, the same thing. Buying the shares meaning that you own part of the company, that you are a stakeholder, you are a shareholder, you are a owner of this company. The other side of a owner can be a creditor, meaning you don't own any part of this company. You may be giving the money a loan. For instance, a bank can loan any money to a company, it doesn't make the bank an owner of the company. It makes the bank a creditor of the company. And the difference between an owner, aka shareholder, versus creditor is very important. Say, for instance, if the company were to go under and it's going through bankruptcy procedures, creditors are put in a higher level to receive any cash payout before the shareholders do. Third, you have to have a long-term perspective when you invest in a private company from a private equity perspective. You cannot be putting in $1 million today into this private company and say the next day, hey, I'm going to take my $1 million out of your company. You have to have a long-term perspective that's measured in years. There's usually a locked-in period of once you put your investment in, there's a certain amount of time that you have to keep your money inside of this private company. You cannot take it out because the private company is depending on the money you put in to continue its growth. Fourth, active involvement. Usually, private companies choose to take a majority ownership of a private company because private equity firms believe that through their active involvement in helping this company to grow, they will eventually make this company more profitable, and by the time they exit, when they sell their shares to other people who are willing to take over the company, they can make a huge return on their active management. They're seeking out potential profitable good deal to buy this company. So overall, active involvement is a key trait when private equity firms invest in a private company. Fifth, capital structure optimization. This kind of comes with the territory of active involvement. So think about it, you put lots of money to buy a majority share of a private company, or you bought the entire company. Of course, you want to optimize the capital structure, how much debt, how much equity, to make sure this company is running smoothly. Six is exit strategies. Usually when private equity firms invest in a private company, their goal is to exit, to make money, because you only make money when you sell something. If you continue to hold, these are unrealized gains or unrealized losses. In general, in life, you want to buy low and sell high. And this is also the golden truth to private equity. You have to exit. I want to talk a little bit about the difference between PE versus VC. PE stands for private equity, VC stands for venture capital. A lot of time in the news, people see a small startup company got founded by lots of VC firms, and eventually the startup company goes public, or you say IPO'd. Then the founders and the employees all became billionaires or millionaires, and it's a happy story. And you see that a lot on the news. However, VC is just a subset of private equity, and taking and they're called venture capital because they focus primarily on early stage startup companies. However, what if you are a private equity firm that's interested in mature companies and help the company grow better and run better, make more money? Then that's a different strategy within private equity. So private equity is this big umbrella, and within the big umbrella, private equity, you have many different strategies. And VC is the strategy of focusing on a startup company. And there's also a strategy that's called buyout. One of the more recent story in the private equity world is Symphony Technology Group, STG. They led a $1.5 billion buyout of SurveyMonkey owner that's called Momentive Global. They basically acquired a public company, SurveyMonkey, and made it private because STG believed that if they have private control of SurveyMonkey, they can improve its operation and make it even more profitable than when it was a public company. So as you can see, not only in the private equity world, not only can take a small company to become big and public, you can take a massive company and make it private and continue to improve its operation as you see fit.